Hey everyone, welcome back. So today I just want to touch upon bond yields, what they are, what they mean, more importantly. It's been showing up on the news a lot more and I've been getting a lot of questions on this. So hopefully I can clarify a little bit here and as concise as possible. So let's get to it. What we're looking at is the US 10-year Treasury and it's yielding 1.299%. Now, this is really important because investors, they want to make sure that this yield is higher than their anticipated rate of inflation. Lately, this bond yield for the 10-year and also the 30-year has been increasing at a pretty alarming rate. Since the beginning of this year, they've both increased approximately 44 to 46%, and it's only mid-February. So that's pretty concerning, especially since increasing bond yields put upward pressure on interest rates. And the Fed wants interest rates as low as frickin' possible. Or else these companies that rely on this extremely cheap debt, they're not going to be able to get it if interest rates go up. And this whole house of cards comes tumbling down. So the Fed absolutely hates this. This is why you're going to hear them talking about quantitative easing, possibly yield curve control. Actually, I'm pretty sure that's going to happen here. Now, since we're on the topic of bonds, it's really important to put into scale how big the bond market is and as a result, why it's so important. So if you see this magenta circle, that's the global stock market. But you see this big behemoth right behind it? It completely overshadows it. That's the global bond market. It's more than twice as big as the global stock market. So you have any problems in the bond market? Yeah, you're going to have problems in the stock market for sure. That's why anytime there's been talk about rate hikes, it spooks the markets because it is built on a very, very fragile foundation that is completely dependent on cheap debt and the printing of money. That is why rising bond yields matter. That is why they're being talked about a lot more. Now, alongside that, I think it's really important to mention the dollar. Lately, what a lot of people have been noticing is that the dollar has actually been increasing in tandem with the bond yields. Now, given our current economy, this is really bad. Stronger dollars mean more imports because we have more purchasing power abroad. So we import more goods as a result, for instance, from China. And a rising dollar aggravates this whole situation because if we're continuing to purchase imports, and we're not exporting sufficiently, which we already weren't before. We're not producing except producing dollars, and we keep up this consumption with more and more inflated dollars. That's the perfect recipe for inflation. It's not helping us get out of this quagmire, and therein lies the problem. Now, I was actually reading this article, and this was actually a couple weeks ago, titled, "Shipping Carriers Rejected Tons of U.S. Agricultural Exports Opting to Send Empty Containers to China." Interesting title. Basically, China's economy has been up and running. It's pretty clear that their economic activity has picked up, and as a result, they're exporting a lot, especially since they're the exporter of the world. So what's been happening is that they're exporting so much because the US is importing so much that they're actually paying premiums on empty shipping containers to be sent back to them instead of shipping containers filled with US exports. I just thought this was really interesting because, yeah, a strengthening dollar means more imports, less exports, but this really drills the point home. This last paragraph here. The ratio of our import-export business is typically 70-30. So even before, in a typical situation, the import-exports were at a 70-30 ratio. Now it's 90-10. Is the strengthening dollar alongside other factors to blame? I'll let you be the judge of that. So that's just a brief overview on bond yields, why they're important, and also why the dollar is important to look at as well. I check these every single day, the 10-year, the 30-year, the dollar index. And if you're serious about your investments, I would strongly recommend looking at these indicators on a regular basis. Anyways, if you have any other comments or questions, please feel free to reach out. Please subscribe, like the video, and I will see you all in the next one.